Income tax. This is the tax most people are familiar with, even if they don't fully understand how it works. Governments have been collecting it for centuries, and today it functions as a percentage of the money you earn from work. The more you earn, the higher the percentage you pay. Most countries divide this into brackets, meaning different portions of your income get taxed at different rates. So if you move into a higher bracket, only the income above that line gets taxed more, not everything you earned. Capital gains tax. When you sell something for more than you paid for it, that profit is called a capital gain, and in most countries it gets taxed. This applies to stocks, real estate, and other assets. How much you pay often depends on how long you held the asset. Sell it quickly and you usually pay more. Hold it for over a year and the rate tends to be lower. The idea behind this distinction is to encourage long-term investing rather than short-term trading. Sales tax. Every time you buy something at a store, a small percentage of that purchase goes to the government. This is sales tax, and it gets added at the point of sale. The rate varies depending on where you live and sometimes what you're buying. Groceries might be exempt in one place and fully taxed in another. Unlike income tax, sales tax is the same regardless of how much money you make, which is why some economists consider it less fair to lower-income households. Value-added tax. Often called VAT, this one works differently from sales tax even though it can feel the same to the end buyer. VAT is collected at every stage of production, not just at the final sale. A manufacturer pays it, then a wholesaler, then a retailer. Each step passes the cost forward. By the time something reaches your hands, the tax has already been built into the price. Property tax. If you own land or a home, the local government typically charges you a tax on it each year. The amount is usually based on the estimated value of the property. The revenue from this tax tends to fund local services like schools, roads, and fire departments. Property values change over time, and so do the tax bills that come with them. Renters don't pay it directly, but landlords often factor it into the rent they charge. Corporate tax. Businesses that earn a profit are generally required to pay tax on those earnings. This is corporate tax, and the rate varies significantly from country to country. Some nations keep it low to attract foreign companies, which has led to a long debate about tax competition and where large corporations choose to base their operations. Many businesses also have access to deductions and credits that reduce the amount they actually owe, so the official rate and the effective rate are often very different numbers. Payroll tax. Most workers have money taken out of each paycheck before they ever see it. Part of that goes toward income tax, but another portion goes toward payroll taxes, which are specifically tied to social programs. In the United States, this funds Social Security and Medicare. Employers also contribute on top of what employees pay. It's one of the more invisible taxes simply because it's deducted automatically, but for many working people, it actually takes up a larger share of their income. Estate tax. When someone dies and leaves behind significant assets, those assets may be taxed before being passed on to heirs. This is the estate tax, sometimes called the inheritance tax or the death tax. It only applies above a certain threshold, so most ordinary estates are not affected. It tends to be a politically charged topic, with some arguing it prevents extreme wealth from concentrating across generations, and others believing it unfairly taxes money that was already taxed during the person's lifetime. Excise tax. Certain goods carry an extra layer of tax beyond the standard sales tax. Cigarettes, alcohol, and gasoline are common examples. This is the excise tax, and it's usually built into the price rather than added at checkout. Governments use it partly as a revenue tool, and partly to discourage consumption of things considered harmful or costly to society. The higher the tax, the more expensive the product becomes, the less people buy it. Tariff. A tariff is a tax placed on goods coming into a country from another country. When a business imports a product, it pays a percentage of its value to the government before that product can be sold domestically. This makes imported goods more expensive, which can protect local industries from foreign competition. Tariffs have been used for hundreds of years as both economic policy and political leverage. When two countries disagree on trade terms, raising tariffs on each other's goods is one of the most common forms of economic pressure. Wealth tax. Unlike income tax, a wealth tax is based on what you own rather than what you earn, calculated on total assets like savings, investments, and property above a certain threshold. Few countries have fully implemented one, partly due to the difficulty of accurately valuing assets each year. The debate centers on whether extreme wealth concentration is healthy for society. Self-employment tax. People who work for themselves don't have an employer to split payroll contributions with, so they pay both sides on their own. In the US, this is called the self-employment tax, and it applies to freelancers, contractors, and small business owners. It catches many people off guard the first time they work independently, since the amount owed can be significantly higher than what they were used to as a traditional employee.